Hello investors, it's Stuart Kruse with Kruse Asset Management, and welcome to Kruse Asset Management's video chart of the day. Today we're going to be talking about U.S. corporate profits. So right now I have a chart on the screen by our friends at YCharts of our U.S. corporate profits. Here's a 10-year chart, and I'm going to point out right now 2016 Q4 corporate profits were at $2.05 trillion. And right now, our corporate profits are $2.035 trillion. Why Q4 2016? Well, that's when Trump was elected. So we had great expansion of corporate profits, little stumble here in the fourth quarter of 2018, reach of all-time highs again. And due to the lockdown, we've given back our 4 years of gains right here. And as we know, long-term, the S&P follows corporate profits. That makes sense. Companies are making money, the S&P goes up when the companies are making money. So here's the orange line is the S&P 500. As you can see, it follows corporate profits pretty well. The S&P is supposed to be a forward-looking indicator. So let's say right here, it was anticipating a decline in corporate profits, so we had a little sell-off. Here again, it was anticipating a decline in corporate profits, so we had a sell-off. And that's what we saw right here. And now, we were anticipating, we didn't really get a chance to anticipate, we just had a lockdown. And so the S&P fell, probably to catch up with expectations as corporate profits fell. Now, our next corporate profit meeting or report will be August 27th, so keep a lookout for that. But right now, clearly the market is anticipating a humongous return in corporate profits. Now let's ask ourselves if that's really realistic. So we're going to return to that for a second. So I'm going to take off the S&P 500 and I'm going to put on PE ratios. PE ratio is price to earnings. I talk about this quite a bit. So right now I have on here, the blue line is the S&P 500 PE ratio with the 10-year treasury rate. And if you notice something, it looks pretty inversely related. So as the treasury rate goes down, PE ratios are allowed to go up. Treasury rates go down, PEs goes up. That's a function of discounted cash flow because they're basically saying as interest rates go up, that means $1 of earnings a year from now is worth less, and $1 of earnings 10 years from now is worth a lot less. But with interest rates at 59 basis points over 10 years, it's basically saying $1 of earnings right now is worth 99.5 cents 10 years from now. So that's not much difference. So that enables quite a bit of PE expansion. But what I'd like to point out is whenever you see a rise in this 10-year treasury rate, you can see, whenever we see a rise in this 10-year treasury rate, we can see a fall of our PEs. So what you might want to be on the lookout for is when the 10-year treasury rate starts to move up, you could see PE contraction. And that could spell trouble for any tech stock, let's say, that has a high multiple, because these PEs come from somewhere. This is an aggregate number of the PE ratios of the S&P 500. So if the top companies like Apple, Amazon, Facebook, Google all have high-flying PEs, and you start to see this 10-year treasury rate move up because of inflation, because of the economic expansion that's being offered, the stimulus packages being offered by the Fed, then you could see compression, in which case the S&P could be in for a headwind. Let's look at something else. We're going to take these charts off and look at consumer sentiment. Consumer sentiment has been kind of flying along for a while here, up in the, look at these numbers, up in the 90s, high 90s, 100%, and then with the lockdown, we drop back down to the 70s, which is kind of where we were back in 2012, a little bit post-financial crisis, and we maintain back here in the 70s. So consumer sentiment is not good. That means they're not anticipating going out there and spending in full force. And of course, I've talked about this in the past, unemployment, which was on a long trend downward, which broke 3.6%. and hit a high of over 14.5, 14.7, is now trading at 10.2, which is higher than it was at the worst point of the financial crisis. So if I look back here at the financial crisis, you can see unemployment hits 10.1 and we're at 10.2. So this is worse than the worst point of the financial crisis, which basically means things don't look all that great in the economy. So how corporate profits are going to have a humongous rebound here. I'm not 100% sure how that's going to happen. So the S&P is anticipating that. I'm going to unmodel my chart. So the S&P is anticipating this huge spike up of corporate profits, but the consumer sentiment and U.S. employment numbers are not suggesting the same thing. So I wouldn't be surprised at all. Here we are. Technically, we haven't hit that higher high. We're on S&P all-time high all-time high alert watch today, and then the market sold off pretty spectacularly within 5 minutes. It was down a couple hundred points almost immediately. So if we don't hit that high and go through it, that's a bad technical sign. I really wouldn't be surprised if we saw another correction 15-20% down. That's a ho-hum correction generally when the Fed isn't manipulating the markets. So to see a market fall of 10 to 15%, it's a kind of typical average correction. And given where we are with the multiples and the consumer sentiment and unemployment, to see this market fall off wouldn't be surprising. So, of course, we're going to invest by the numbers, and then we're going to make sure that our clients at Kruse Asset Management are investing with the odds in your favor.